Welcome to Real Wealth, Real Health, the show that empowers you with insights, information, and inspiration to achieve your version of financial wellness. Learn how to balance living a full life today with planning for the future. This podcast is brought to you by Alpha Investing, a real estate-centric private capital network that provides exclusive investment opportunities to its members. And now, here are your hosts, Ada Piederico and Daniel Coca.
Hello, and welcome back to another episode of Real Wealth, Real Health. This is the first episode of 2022, and it is such a pleasure to welcome back Akhil Patel. Akhil is the director at Property Share Markets Economics. He is a leading expert on economic, financial, and property cycles. We had Akhil on episode 21, which was the kickoff episode for the year 2021, and so we're bringing him back to kickoff 2022. In this conversation, we get a lot more in depth into the mechanics of the 18.6-year cycle, where we are in that cycle, if we're tracking to the way that they track the cycle, and we are tracking according to the 18.6-year cycle. We get into some predictions for the coming year and practical ways that investors can use the cycles to inform investment decisions. So we are in the growth phase, the second half of the 18.6-year cycle, where it is expected that we see a lot more asset growth, a lot more property, land, real estate pricing growth. So this is a very important episode for anyone who likes to track macroeconomics, who wants to know information that is not what is reported in the mainstream, to really inform a more precise and refined strategy for investing in real estate. I love to nerd out on this stuff with Akhil. I hope you will find this episode as interesting as it was for me to get into with Akhil.
So if you read your history, you come to the view, and I know you're working your way through Phil's excellent book, you come to the view that actually the cycle pretty much times all the time, and often it's something people haven't thought of, comes about to kind of make the cycle happen. And it's happened so regularly in history that it's not, you can't say it's just a lucky coincidence. It's happened over and over again for 200 years or so. So I think that's the kind of the first general point. The second point is, Phil and I are on record saying at the beginning of 2019, we did a webinar in London for some of the subscribers of my old newsletter. And, we basically said we are at the point in the cycle when we're expecting the mid-cycle recession. We can see certain economic data is telling us that actually the global economy is slowing down. We use slightly different cycles to kind of do a roadmap for the stock market. We can see that 2019 will be a strong year, but actually we're looking for a top in 2020. And given that stock market cycle topping out with the idea that the global economy is moving into recession, means that actually we're expecting some kind of panic in 2020. Yeah. So this was in 2019. And that's exactly what we got. And it's kind of fitting the two things together. Clearly, we didn't know that COVID was going to happen. And, frankly, not many people did. We didn't know that the reaction to COVID was going to be as significant as it has been. We didn't frankly think that Western governments could shut their economies down pretty much indiscriminately. But we did know once that had happened, and we had a lot of people saying, well, this is going to really crash the property market, and this is really going to, this is the worst recession since the Great Depression. And in the UK they were saying it's the worst recession in 300 years, and people were providing all the data to show that it was. We knew that actually the recovery would be quite quick, that the banking system would be quite using all the money they'd saved during lockdowns, where they wanted to live, because the pandemic has caused a few people to make some kind of decisions that they might not otherwise have done. But that's always the case. I mean, people made different decisions after 9/11, for example, this time last cycle. There was always something that comes in, but the ultimate kind of cause of the cycle, which is, how the property market behaves and ultimately how the thing goes into overdrive, and there's a lot of speculation and a lot of bank lending. That never changes, and that's ultimately what gets you to the crisis point.
So we've seen at Alpha, because we're doing, we're private real estate, and most of it last year was multifamily. And we actually started to invest a lot in single family rentals because it's about 50% of the US rental market. 50% of renters live in detached homes. In other words, a single family renters, not apartments. And there are better yields there than there are in multifamily, because about 50% of multifamily is owned by institutional investors, whereas only about 1 or 2% of the detached home single family rentals owned by institutions, but they're quickly turning their attention that way. So many of the trend, COVID really accelerated so many demographic trends, including that. And we saw just cap rates come down so quickly, like in a matter of months. It was almost like dizzying how quickly it came down. And yet the belief and what's being executed on, and what, is still happening when they're coming full cycle, some projects even from 2020 already, is that people are willing to pay for the NOI growth. They're willing to pay much higher, essentially, property prices than we would have ever expected. We're not underwriting cap rate compression. We just, just to play it safe, I would say. But we're seeing it. And the question is always, for how much longer can this go on, so to speak? And then when I look at the clock and when I look at the cycle, it looks like for another few years, just based on the cycle.
Well, you always get a sustained period where people are paying more and more for assets. I'd probably say at this point in the cycle, we're still kind of coming out of the mid-cycle recession. There's still an element of recovery. I think the next sorts of things we'll start to see is, earnings and wages increasing, and therefore rents will, to a certain extent, go up, which I think alleviate some of the pressure on cap rates. But I think the reality is that people will pay more and more, and I don't see there going to be much recovery in those metrics. People just get used to paying more and more, and until it becomes normal. So price anchoring is still very much kind of at the levels it was at the first half of the cycle or in previous cycles. After a couple of years of cap rates being where they are, people will think that's the new normal, and then they will, they'll continue to pay more and more, borrow more and more, and that's, you kind of need to see that in order for the peak to arrive.
Right. And you have in the clock that the next, so right now would be like the land boom, and then the lavish spend on public works, which at least here in the US, they're still trying to finalize this Build Back Better, but essentially some version of it is going to get pushed through, I would imagine. So again, it's like there it is on that clock. Like by the time that that money actually starts to flow through into the economy, I would imagine it's going to be 2023, 2024.
Yeah. I mean, there's always going to be stuff around election times in the US.
Right.
The year before an election, when all these sort of additional measures come forward, or tax cuts, because that also puts more money into the economy, or leaves more money in the economy, which then go into real estate. Yeah, I mean, that side of things was really interesting. I mean, in a sense, you could get an infrastructure bill at any point. Why the second half is because, by the second half of the cycle, you've had the mid-cycle recession. One of the responses that government makes to the mid-cycle recession is, reducing interest rates and or increasing public spending. So that's kind of, that's basically almost like clockwork, a response to the mid-cycle recession. But also, I think, whereas at the start of the cycle, there's so much fear about, no one really knows what's going on and so on. There's maybe that holds things back a little bit. One thing that I think is very clear from Phil's book, and certainly it's a point that I make quite a bit in the book that I'm currently writing, is that each new cycle starts off with some kind of new technology dominating some of the discussion, and some of the way that new businesses are formed. I think by the time you get a few years into the second half of the cycle, some of the investment needs in relation to that new technology are very apparent, and therefore, the response is then to roll out public investment to respond to that.
Would that new technology be Bitcoin and cryptocurrency that technically started in 2008, but has really come into its own during this mid-cycle recession?
Well, I'd go a bit sort of further back than that. I'd say that probably the thing that really changed things, the game changer in 2007 was a smartphone. The smartphone, 4G, suddenly everyone had a very high powered computer with a fast internet connection. And you can see the enormous number of industries that have been created just on the basis of that, social media and, ride sharing and other things. And to a certain extent, I mean, Bitcoin wouldn't be nearly the sort of technology it would be if, you had to access it via a desktop computer, for example. So I think that's kind of it. Bitcoin for me is a good candidate for the new vehicle for channeling money into the real estate market. So there's always something. So in the 70s, they developed the new kind of real estate investment trust vehicle. In the 80s, there was a lot of kind of derivative trading and so on. In the 2000s, the financial industry innovated in terms of securitization. And in the UK, a lot of buy-to-let, what we call buy-to-let mortgages. So a lot of third-party investors buying up property to rent out to people. There's any number of vehicles now. We've got SPACs, we've got cryptocurrency, we've got meme coins, got meme stocks. You've got a lot of young traders who kind of regard trading as a bit of a game, and the apps are designed as games. And they've had a couple of very good years, and in fact they might have several very good years, and unfortunately it'll all come crashing to an end at some point. So I mean, everyone ultimately learns the same lesson in markets, and there's no avoiding those lessons. So, and there's for all the talk of a new era, blah blah blah, I mean it's not the first time that someone's thought it's a new era. So,
I mean, it always comes back to human behavior psychology and to some degree the emotion underlying it. I mean, otherwise that's the only thing. Human nature is the only thing fundamentally that underlies a cycle, despite what it looks like on the outside. Underneath it, it's still, there's that human psychology. And even for a while when I was younger, I used to think, poo-poo the past, don't look at the past. Those old people don't know what they're doing, I think most young people. And then, I don't know at what point I actually, maybe just got a little smarter and said, well, there's probably a lot to learn. I got old. That too.
I said older, not old. But there's a certain wisdom in years, isn't there? So
yes, yeah, and I really appreciated. I talk about him a lot, and I think we talked about this last year too. Is Ray Dalio, he does all this historical economic research, and he brings it forward. And same with Phil's book, where he's bringing forward and he's showing how the cycles played out every single time. And underneath it is what we know very easily as fear and greed. It kind of underlies all the cycles. And I know you talked about that in a few of the videos in that November presentation. So what have you found with that and this conversation about human nature and human behavior that underlies the cycles?
Well, I mean, there's actually a huge number of ways in which it sort of influences it. You tend to, I mean, I think there's an old adage in markets that, they can't peak when there's fear, because not everyone is in the market, and it's only when that's flipped around to greed and everyone's the fear then is not fear of things collapsing, it's the fear of missing out, or greed, and greed rules the way. There's no consideration really of fundamental kind of metrics. It's just about whether you can make a profit, a capital gain. When that happens, you're in the point at which you can get a peak in the market. And then the question is, when's that going to happen? And it seems to be that process just takes 18 years for whatever reason. And, it takes 18 years for us to get to the point when all the skepticism has been overcome. And you get the peak of the cycle. On the other side, at the start, when things have crashed, it's 4 years since the last peak, stock market is typically down 50%, and we know from our sort of writing of financial publications that at the start of the cycle, when we are saying, Phil and I, that this really is the best time to be buying that you'll ever see in your lifetime, probably the only publications that will sell are the ones that are forecasting the end of America or the end of Australia or the end of the UK, or the collapse of the dollar, or et cetera, et cetera. And you can't get people to pay attention, and that's because fear is so prevalent that they can't. And everyone has an opinion about what's going on in the economy. It's usually that, and it's actually quite funny to read historical narratives about it. You don't see this so much in books that are written now, but if you go back to newspapers back in the day, I mean, after the bankers' panic of 1907, they did a sort of investigation, people saying, well, this has been caused by the spending patterns of women. They're obviously overdoing it, and they've got too much freedom, too much control over the family purse, and so that's led to this overconsumption, etc. They're searching for all these outlandish explanations when they should really be confident that actually at that point, maximum fear, everyone is out of the market, there's no more selling to be done, so the only way by definition has got to be up. But of course emotions are very powerful and you can't see that. And you get to a certain extent similar kinds of dynamics at the mid-cycle recession, which we've just been through. So and actually Dalio is an interesting character to raise, and I know that I was maybe slightly dismissive of his very good work, and of course he manages a lot more money than I do, and he's a lot more well regarded than I am. But in 2018, everyone who was in Davos was pretty bearish. I think I'm right in saying that. No, sorry, 2019. January 2019, everyone was pretty bearish, and of course then 2019 was a very banner year in the stock market. At the start of 2020 they were very bullish, and I think it was even a member of the top team at Bridgewater said that the business cycle is kind of different now, and Dalio said that cash is trash, and so on. So even the biggest names in Wall Street are kind of looking the wrong way at these important points in the cycle. Of course, it wasn't the major crisis that we had in 2007, but you do get the kind of same things. You had the greed, and then of course in March 2020 and the summer of 2020, it was looking like we're on the brink of some kind of major economic collapse. But of course it wasn't. It was in fact the best time to be buying stocks and property in the next 7 years.
Right. Yeah. So many questions. One thing that I did want to touch on is the relationship between the stock market and there's like a 10-year cycle you said about stocks. And I know this could maybe be complex, but to the degree possible, how does the 18.6-year real estate cycle interact with some of the other cycles? And how do we use those to understand when to be buying and selling, whether it is stocks or real estate?
Yeah, so the relationship between those two cycles is fairly complicated, but it is I think fundamentally the stock market doesn't go up when you're having an economic crisis. And so therefore the most important thing is to understand where you are in the real estate cycle. And I think very few stock market traders get that, partly because they're not, no one is really taught that land has this sort of fundamental role in the economy, and so therefore they don't really see the economic cycle. Of course they might understand shorter term stock market cycles, which to a certain extent is quite helpful. I think one of my publications for property share market economics combined so what I did is I took the Dow Jones Industrial Average, or the broadest stock market index for the US that I could find. Obviously the Dow Jones didn't exist in 1800, and cut it up into 18-year segments and then sort of combine them. And what you see is a pattern which is very close to the idealized pattern of the real estate cycle, i.e. there are two halves of where stocks are going up, and there is then a mid-cycle recession, which in some cases, like in 2000 and 2002, between 2000 and 2002, the stock market came down about 40%, so quite significantly. Other times the mid-cycle recession is the markets are trading through a range like they were in the early 80s, or very sharply down and very sharply up again as it was in 2020. So that can be a bit of a variable thing, but the stock market comes down at the end of the real estate cycle by at least 50%. There are a couple of occasions where it's been a bit less, and there's been some occasions such as after 1929 where it's been significantly more. So to answer your question, the main thing is the 18.6-year cycle, but within the kind of decadal cycles, which we write about quite a lot in our annual roadmap, you typically find the first couple of years of a decade tend to be relatively up and down, shall we say. It's not been so much the case in 2021. 2022, I think, is going to be interesting. So our 2022 roadmap, I think, will be quite a good read. But anyway, that sets a foundation for what tends to be pretty strong years in the middle of a decade up to a peak, depending on where we are in the real estate cycle.
Right. Right. And it seems like the real estate peaks before the stock market in that.
Well, land does.
Land.
Yes. So
okay, can we distinguish that actually? Like that, I think that's really good because I know that there's land, and then you talk about the economic rent of land, and then obviously within real estate we have primary home, we have what we do private, there's REITs, there's I know one of the leading indicators is the construction home builder stocks. So yeah, can we get into that a little bit to clarify?
Well, we don't really measure land. I mean, but fundamentally we're talking about real estate cycles, we're talking about land cycles. So when a property appreciates, it's not the building which is which is wearing and tearing and is going down in value. It's the underlying land, and the value of land is a reflection of the quality of local infrastructure, and the prosperity of the community and the size of the population, and other trends like are businesses coming in, are people relocating there and creating demand for that location, which is a scarce asset. So that's basically what drives the economic cycle, drives the real estate cycle, and so on. Land tends to peak before other assets, at least residential land, partly because people will overbid for housing for a number of months after land has peaked, because we're talking about raw land which builders are developing, and it takes a bit of time for that to feed through into the rest of the market. That's the first thing to peak in the cycle. Then you will then see it in house prices, particularly for new buildings. There's no longer the same kind of expectation of growth. Builders will then tend to hold out for higher prices. That will slow the volume of transactions, which is one of the reasons why house building stocks then tend to peak and start to come down, because analysts recommending those stocks are not seeing the same growth in earnings. That's why it's a leading indicator, because the broader market is typically going up or continuing to go up for a bit longer, because they haven't quite figured out the impact on the rest of the economy.
But those tend to peak like a couple years, seems, based on what I was reading. It seems like it can peak like even up to like a couple, like 18 to 24 months before the land peak, the builders stocks,
before the stock market peak,
before the land peak.
I mean, it's possible in some cycles that the analysts have worked that out in advance. I'm not sure they were too far ahead in 2006, which is when I think land peaked in the US, early 2006.
I meant it peaks like a couple years before the bottom. So like it peaks, and then land slightly peaks, but like you can see in the charts, you can really see that like the home builder prices peak, and then 2 years later it's like the bottom pretty consistently.
Yeah, I mean, we don't have as much great data going back, because a lot of these stocks weren't listed prior to the 70s, but that is typically a 2-year process to get to the really darkest point of the cycle, and then you get the sort of start of the turning things around, the rescue period for another couple of years, and then you get to the confirmation that actually the new cycle has started, by which point probably the stock market is already starting to trend up again. So the stock market tends to be late at the end of the cycle, so there's a bit of euphoria that takes it beyond the land cycle peak, and then the stock market will come down typically very hard and find a low before land falls to its lows, or before you start to get any meaningful recovery in land prices.
Yeah, so I wanted to actually ask about the home building, because we're seeing a lot of construction now in the US, and I was looking at the home builder stocks that are at all-time highs quite significantly. And a lot of news or statistics out there, people are saying there's still not enough homes for the demand, or places to live, whatever, housing supply in general. There's just not enough of it, because everyone stopped building at the Great Recession. So 2007, 2008, everybody stopped building. And it seems that just now they're finally starting to come back and build again. I wonder if, I guess my question is, I wonder, are they going to be able to build enough homes before the next crash, and then we're still undersupplied? And is that just a chronic thing going forward, that we're always undersupplied? Because by the time these guys are like cranking back up to build, a few years in, we're crashing.
I mean, I think that there's always authoritative forecasts related to how few homes are being built. I mean, I think it's probably more accurate to say they're not being built, or they weren't being built, or they're not in the places where people are now moving to, and people are moving to secondary and tertiary cities. In this case, it's, coronavirus seems to be the spur, but there's always something, and it's partly because they're priced out of, the primary cities, and so are businesses as well, and they were looking for cheaper places to employ people so that they can cut on the costs. So that there's that kind of same dynamic at play. I think the issue with building, though, the second half of the cycle, is that everyone is building very hard on the basis of the same forecast, and no one is actually coordinating to see that we're not overdoing it. But regardless of that, it's also part of the price. So if people are not buying or they can no longer afford to buy what everyone is cranking out, because they need to make a certain return on their costs, and part of their costs includes inflating land prices, then that is going to tank the market, because you can't shift that stock. Then you get a chain reaction. Banks are no longer, they have a bunch of bad loans on their balance sheets. They'll stop lending to the rest of the economy. That will slow businesses down, and so on. But property market starts to tank. Banks become insolvent and need bailing out, and there's a stock market crash. So it does, it can be, things don't need to look that bad in general for there to be a major crisis. So most of the counties in the US in 2008 were actually okay in terms of loans in arrears and banks having lent to them, and still being, having a rising number of bad debts, but it wasn't crazy. But when Bear Stearns and then Lehman Brothers collapsed, it just precipitated a major crash based upon what ultimately was a relatively small number of bad subprime mortgages. And that led into other problems, with certain banks. Then the interbank market, or the repo market, dried up as banks stopped lending to each other because they didn't know how, who owned what, and so on. And so then you had a much greater crisis of confidence, which, spread around all over the place. So it doesn't necessarily take too much, which is one of the reasons why you need to kind of follow what's going on at the margins, as we say. So in the kind of smaller communities where there's still quite a lot of building going on, but there's a smaller population, there's actually probably thinner demand if there's some kind of bad news, and so people stop going there, and suddenly you've got 5 house builders who've suddenly got 80 properties to offload in the next 6 months, and there's simply not any way of doing it without tanking the market.
Yeah, we've seen a lot of the secondary, tertiary market migration here in the US, and there's been a massive out-migration from California, Illinois, and New York State. Those are the 3 net losers. And obviously Texas, Florida, Tennessee have been net gainers, but especially Texas and Florida. And so you have like the Dallases of the world now are very big markets. Like, they're very active markets. A lot of companies are moving there. There's a lot of jobs being created. And then from there you see, it's not affordable to be in Dallas anymore. So now it's Fort Worth. And then people are moving down to, Houston. And then you get Fort Lauderdale and Tampa and Florida. And you really start, it just spreads. It just trickles. And we're seeing some very tertiary markets with 4 caps. Like the very tertiary markets that you would never have assumed that random towns in Ohio are now being bid up like crazy. And so, so it makes a lot of sense. So it's like where it's almost like musical chairs. Like, it's like, where does it stop? What town is the one that by the time everybody gets there thinking, oh, this is the last bastion of this is where I'm going to get a good deal. By the time they get there, the chair's gone and there's nothing there,
I mean, that's the $1 million question in a sense, but you don't, in some ways you don't need to know that. You just look at kind of what's going on in the stock market. It will tell you kind of that actually this is no longer this is no longer now a market that is flowing in the way that it was. And this is the thing. Once you get to a speculative peak in the market, it can only be sustained when the flow of capital into it is increasing year on year. If it slows down, then prices have to fall. They can't plateau. They're either going up or they're going down. And you'll see that first in the stock market if you know what you're looking for.
And so in the cycle, what is the winner's curse?
It's the final 2 years of crazy, mad behavior where people are speculating like there's no tomorrow, and then fundamental values don't play any role, or maybe more precisely, when people are bidding for real estate, they aren't just bidding for price based upon the current level of rents or earnings. They are assuming an increase in earnings next year and a capital appreciation. So they're playing for tomorrow's growth today. You get that a lot on the winner's curse. And so it's the curse is that you have enough money to actually beat off the competition to acquire that asset, because 2 years after the peak, it will probably be underwater.
Right. As an investor in real estate, would someone, if I buy now and knowing what I know, and I think I'm going to buy now and I'm just going to hold it, am I better off holding through the next bottom, or am I better off selling at the next peak and then buying at the bottom?
Depends on the asset. So if you've got good quality assets in good quality locations where there's going to be long-term demand, you've got assets which median buyers want to have, i.e. so there'll be that sort of continued demand for it. I don't think you should ever sell those, frankly. If you've got, say, slightly less valuable assets, but now nonetheless they might be doing well for you, the time to sell would be a year before the peak. So you sell your lesser quality assets in the rising market, and don't try and top the very peak. Just leave a bit of money on the table for the poor sod who's going to buy from you.
Yeah. Well, I mean, there's I really like this idea of buying to hold, and if you're going to hold for long enough and it's a good asset, then why not hold? Even let's say somebody today is saying I have some money for the next couple of years, and I'm, even though there's a lot of bidding going on and prices are going up, but if it's the right asset, then just hold it through the next downturn. Because then I think about, in parallel, I think about the stock market, and I think about, the average returns of the stock market and how people's savings and retirements are halved, right? When it crashes. And, do you hold through that? Do you, obviously if you're dollar cost averaging, you continue to dollar cost average, but there's also that question of, if you know what you're doing and if you know what to look for and you can somewhat time it appropriately, you can maybe avoid losing as much and then buying at the bottom. I think it's really hard for most people who can't do that, and they panic sell instead of hold. So it's always a toss up for me with the stock market stuff, because it's more liquid, obviously, than real estate, and you can, that emotion can grab you.
Harder. Yeah. Well, I mean, there's no one answer to that question. It really depends on why you're invested in the stock market. If you're someone who lives off dividends and you've got a bunch of utility and healthcare stocks which have very solid dividends, actually you can't really sell because you won't have your income. So you might want to find some kind of way of hedging or just ride it out. I mean, the worst thing is, of course, to be the sort of stock market investor who has made money in business, say, and wants to diversify their earnings. They buy stocks 1 year before, and then it comes down 50%, and then they think, oh my god, this is going to go down much further, and then they sell right at the bottom, which basically happens a lot. So if you are riding down, if you are in the crash phase and you can hold and wait for the recovery.
Good. That's good to know. Yeah, I think for a lot of people, that's a big question. So now that we're in the second half of the cycle, and I remember this from your presentation, there's strong cyclical sectors. And I have a slide up here that I screenshotted from the presentation, but basically you have infrastructure, commodities, real estate, banking and fintech, the green transition, and defense and aerospace. That's what, if somebody's thinking today cyclically, and I know that tech kind of falls out of favor at a certain point with maybe it's, due to inflation and certain things that are going on today. I've seen a lot of other economists as well talk about the cyclical shift out of tech stocks and, maybe into this. So can you talk a little bit about these sectors?
Well, they're mainly related to the themes that you find in the second half of each cycle. So, obviously real estate and banking is hopefully obvious to those who kind of understand a little bit about the cycle. But there's, we've talked about the massive rollout of infrastructure and a lot of construction going on around the world, not just in the US, but also in the UK, in Europe, China, and the Chinese Belt and Roads Initiative, which I think they're going to call something else. Got a burgeoning middle class in Africa. So all of the infrastructure needs to go in that. So there'll be a lot of construction. So companies that are exposed to all of that activity should do well. We're also in a commodities cycle, upside of a commodities cycle. So, and that's consistent with the real estate cycle. A lot of construction going on, a lot of demand for raw materials. And by the way, and these are sort of slightly longer term trends. I'm not saying that necessarily next year in the first 6 months you're going to get a massive boom in, say, the price of iron ore. There's actually some of those commodities are looking a bit weak at the moment. So those are some of the themes. We also know from history that when you get the final few years of the commodity cycle, it tends to be also one where there's a lot of geopolitical tension, partly related to making sure that you have access to natural resources. So defense and other kind of stocks are part of that process. Tech does fall out of favor to a certain extent because I think what finds more favor at the moment is particularly in an inflationary environment is companies with good earnings, and some tech companies have earnings in the future but not necessarily now, so that might not do quite so well. But I would have to point out that you can see a lot of large tech companies moving into kind of real estate type or finance type areas, so they're exposed to that half of the real estate cycle. So it wouldn't surprise me at all to at some point see an Apple mortgage or a Facebook house building company or something, and so their share prices might reflect, therefore, not so much the core business but the real estate business or the finance business or the construction business.
Right. Yeah, I've seen a lot of it. There's been for years now. I've seen a lot of like, I wouldn't necessarily call them consumer company, but not finance companies opening finance divisions, which, of course it's mostly lending because that's a great way for them to make money. And now there's this big push around cryptocurrencies, whether Facebook ever has their own. It's just been interesting, I guess, in general. What I'm trying to say is that I've noticed over the years, a lot of companies sort of suddenly have their own financing so much more than before. I'm pretty sure Walmart has a bank of its own.
Yeah. But I mean, actually you saw some of that in the 2000s as well.
Right.
I think GE, General Electric, didn't they have some kind of financing arm? I know that in the Japan bubble in the late 80s, a lot of these, large Japanese industrial companies that, were world leading, making cars and televisions and other things, also went into speculating in the stock markets in real estate. So that when you get a boom, people find that it actually pays much more to be speculating in assets than it does to actually be making things. And so you'll see a continuation of that, probably on a level that we've never seen before, and more global than we've ever seen before. I think that's certainly going to be each cycle contributes something different to our sort of experience, and sort of the global nature of it, the sort of slightly ephemeral nature of it in some ways, with all sorts of companies that you don't really know what they do kind of being part of the action. I think will be the contribution this cycle, just as last cycle it was a lot of using computing power to make decisions about credit, for example, and in other cycles it was things like in Japan introduced the interest only mortgage, or the 100, in fact they introduced a 100-year mortgage and all this sort of thing. So there's always something new that comes up each cycle, and that's probably the arena where we'll get something new this time.
Yeah, it'll certainly be interesting to see this cycle play out and continue to see this year play out, the more I dig into the content and all the newsletters and everything that you're all putting out there. It's been very helpful for me to understand everything. Plus I'm in the space and in the industry to a certain degree. And so, yeah, I try to watch it, and I'm always trying to watch the emotionality of, there's always FOMO for everyone. I don't want to miss out. It's going up. Oh, buy the dip, you catch a falling knife sometimes. Like there's so much emotion that goes into it. It's really hard to keep that emotion separate, the excitement, which the word greed for me, I always think, well, I'm not greedy, I'm just excited.
Yes.
I don't like to paint myself with the greed brush but there's a level of excitement that goes into it. And as I think about 2022 and the couple years that we're coming out of, I am thinking a lot about volatility. And what is your expectation about volatility? What can we expect? I think in one of your presentations, you were saying that the first couple of years in a new decade are always volatile, or years ending in twos are volatile, if I understood that correctly.
Yeah, they can be. I mean, so a year's ending in one often, and we didn't get a huge amount of volatility last year just because there's so much going on in terms of stimulus and the possibility of a massive infrastructure bill and so on. But I would be very surprised if we emerge from 2022 without some kind of, I wouldn't say crash, but, significant sell-off in the stock market, or at least something that seems significant given that we haven't really had much of a correction for the last, almost 2 years now. So I think that's likely to be on the cards. I'm still sort of finalizing the roadmap that I mentioned that we publish every year. So I'm still trying to think that through, how that might play out, because I don't want to give the impression that everything happens the same way every time, because it doesn't. Mm-hmm. It's trying to work out how all the different things somehow contribute to the cycle repeating, which they always do, because we can see that from history. It's just that when you're in the middle of it, it's sometimes a bit hard to work it out. And so trying to work out what might bring around sort of volatility that you normally see at the start of a decade in the first couple of years after a mid-cycle recession is not so easy. It could well be something to do with politics or geopolitics. Personally, I think the inflationary concerns will start to ease off a little bit, but there might be something related to that which comes about. And I think, given that stock markets the US stock markets have gone up so hard in the last year and a half, that will cause some people to pull out, some people to panic a little bit. And so you'd want to be a bit careful. But, the point is, understand where you are in the real estate cycle, know that even if you do get a drawdown of 20%, it's not catastrophic, and actually would be quite a good buying opportunity.
Right. And that's where we're at in the cycle right now.
That's where we're at in the cycle.
Awesome. Well, Akhil, thank you so much. This was a lot of fun. And I know I took us in so many different directions, but the 18.6-year cycle that you work with, plus all the other cycles, it's so rich. There's so much there to understand. And I would say, for people that are listening, when you start to get into it, it might seem maybe it's simplistic at first, but then when you start to get in, then it gets overwhelming, but then it all starts to make sense, because then what you see out there, whether you're doing your own transactions or the media, you see the stories and they all start to line up, and it's a really something else. So yeah. So I just want to say thanks again for coming on. It's always so much fun. One last question for you is actually, when is your book coming out?
Well, I am about to hand in the first draft to my publisher, and so I think there will be a 6 to 9 month process thereafter. So hopefully it'll be in time for Christmas next year, or well before Christmas, but certainly make a good Christmas gift if anyone's listening to this. And yes, but I mean, just to your point about there being so many different sort of details and points of interest that you can point to and you can put together, I'm actually finding it a bit of a challenge to write, because there's so much I want to say and so many themes that I want to raise, but in a way that doesn't confuse people. Anyway, that's hopefully my editor can help me sort that out when I give him the draft.
Yeah, I get that, because it's a lot, and it's a lot to hold and to explain to somebody a pattern that is so nuanced.
Yeah. There's a lot of moving parts.
Yeah.
There is a lot of moving parts. But, if the first version is a bit of rubbish, then I will do a second edition.
I'm sure it'll be great. And when you have it, you'll let me know so that we can let everybody know. And I'll certainly be buying a copy because I'm still working my way through Phil's book, which is really big. So, but yeah, good luck with the book. And, thanks again for coming on. And, we stay in touch in all the content. So appreciate you taking some time again this year.
Thank you for having me.
Thanks for tuning in to Real Wealth, Real Health. We hope that you've enjoyed today's episode and found it both informative and insightful. We welcome all your questions and your feedback about today's episode, and especially we welcome your questions about specific topics that you would like us to cover. So shoot us an email at podcast@alphai.com. And if you have a moment, we really appreciate ratings and reviews as it helps us grow our online community and our interactions with you. And we'll also be linking to a number of relevant articles on topics that we might have touched on during our conversations. Some of them are broad, some of them are technical, but we're always aiming to provide information that helps you better understand the mechanics of building this healthy financial foundation, especially if you're looking to do this with real estate.